There are 50,000 publicly traded companies in the world, and only one Nvidia. Let that sink in. Because when you understand just how scarce Nvidia really is, and what it means for the future of AI, tech, and investing, you might start to realize something surprising. Nvidia, the most valuable company in the S&P 500, might actually still be undervalued. Investors love talking about valuation multiples, 30 times earnings, 50 times sales, PE ratios, the whole spreadsheet zoo. But what we often forget is this: scarcity drives value. There are thousands of good companies, dozens of great ones, but there's only one Nvidia. Not just in terms of stock ticker Nvidia, but in terms of what they do, what they enable, and how impossible they are to replicate. You can think of Nvidia like a Da Vinci painting. There are only so many masterpieces. And when one becomes essential to the next stage of human progress, whether that's the Renaissance or the AI revolution, its value compounds. Nvidia isn't just a chip company. They are the power grid of artificial intelligence. Every foundational model, every large language model, every enterprise AI platform relies on Nvidia's GPUs to do the thinking. If data is the new oil, Nvidia is the refinery, and the tanker, and the gas station. They dominate 80 to 95% of the AI chip market, depending on how you slice it. That's not just a moat, that's a castle with dragons. The more the world adopts AI, whether it's healthcare, finance, autonomous vehicles, or consumer tech, the more demand there is for Nvidia's hardware and software stack. Nvidia is currently trading around 30x earnings. On the surface, that might look expensive, but here's the twist. This multiple is on today's earnings, in a market where tomorrow's demand hasn't even arrived yet. This is like buying Amazon in 2009, when the world hadn't figured out what cloud computing was going to become, or Apple before the iPhone defined the decade.
Well, to me, Nvidia being the most valuable company in the S&P makes a lot of sense. I mean, that's scarce. I mean, how many Nvidias are there in the world, right? There's 50,000 stocks. There's one Nvidia. And so it is scarcer than like Da Vinci. So I do think the multiple at around 30 times is actually not that extended, given how important they are to the AI ecosystem. So I think there's earnings visibility and then there's multiple expansion potential.
Nvidia doesn't just have strong earnings today, it has visibility into future earnings, and that visibility is more valuable than ever. Here's something else investors are missing. Nvidia is building a second engine, software, cloud services, and entire AI platforms. Think Nvidia's CUDA ecosystem, DGX Cloud, Omniverse. This is high-margin, subscription-like recurring revenue. Once customers start building on Nvidia's platform, they stay. It's a brilliant flywheel. Hardware leads to software, software locks in customers, and locked-in customers generate predictable growth. Of course, no company is invincible. Nvidia faces risks: regulatory scrutiny, geopolitical exposure to Taiwan, competition from AMD or custom chips from Google and Microsoft. But here's what matters. Even if Nvidia loses 20% market share to competition, they'll still dominate a market that's growing exponentially. So, is Nvidia overpriced at a $3 trillion market cap? Or is it like owning Manhattan real estate in the 1800s? Expensive only if you don't realize where the future is headed. The mistake is thinking of Nvidia as just a semiconductor company. That's like calling Apple a phone company in 2010. Nvidia is the picks and shovels for the AI gold rush. and there's only one of them. So yes, Da Vinci's are rare, but Nvidia, they're rarer, and possibly just getting started. We used to think Bitcoin would be the global digital currency. It was supposed to replace fiat, be borderless, permissionless, and stable in its value over time. But here's the truth. Bitcoin hasn't lived up to that part of the dream. It's still a speculative asset, not widely used for payments, and far too volatile to be a real medium of exchange. Ironically, the thing Bitcoin was trying to disrupt, fiat currency, is exactly what stablecoins are leaning into, and that's why they're winning. Stablecoins, especially those backed one-to-one by U.S. Treasuries or cash equivalents, are becoming the quiet infrastructure of crypto and fintech. And let's be clear, this is no longer a fringe experiment. USDC, USDT, and a few regulated newcomers are now moving billions of dollars daily. They're powering on-chain settlements, cross-border payments, crypto trading, and increasingly, real-world commerce. They offer the stability of fiat with the flexibility of crypto. They don't replace the dollar, they tokenize it, and that's the genius. Here's where things get even more interesting. What's backing these stablecoins? U.S. Treasury securities. In a weird twist, crypto, born to escape the legacy financial system, is now anchoring itself to its safest asset. That move, backing stablecoins with short-dated treasuries, did something Bitcoin never could. It gave institutions confidence. It made regulators pause and think, okay, maybe this isn't just shadow money. It made the crypto dollar safer than bank deposits in some cases. This is how you go from an experiment to infrastructure. And now we're seeing stablecoin issuers eyeing public markets. Circle's IPO plans aren't just about capital. They're about legitimacy. They want to be seen not as a crypto company, but as a next-gen financial services institution. Think about that. They issue programmable dollars. They're regulated, transparent, audited, and they settle faster than banks. We used to think JP Morgan or Visa would digitize money. Now it's looking more like Circle or Paxos. Companies born in crypto, but maturing into trusted dollar distribution rails. But here's where the light switch flips. As we enter an era of agentic AI, where autonomous agents make payments, request data, interact with blockchains in real time, they won't tolerate friction. They'll transact instantly, globally, and continuously. That kind of system needs a settlement layer that is stable, programmable, globally accessible, and 24/7. Bitcoin can't do that. Bank wires can't do that. Stablecoins can. Add DeFi to the equation, where lending, borrowing, and trading all happen on-chain, and stablecoins become not just useful, but necessary. They're the oil in the machine. Traditional financial institutions are watching this unfold, and some are still hoping it's just hype. It's not. This is the transformation of financial plumbing, and the smart players are adapting. The rest, they'll be disintermediated, because programmable money doesn't wait, and AI agents won't log into your online banking dashboard. They'll talk to smart contracts, and they'll settle in stablecoins. So if your rails can't plug in, you're out of the loop. That's why we might be looking at something wild. The next globally systemic financial institution, the next JP Morgan or Visa, might not be a bank. It might be a stablecoin issuer. If you're building the default digital dollar for AI, for DeFi, for payments, for everything, you're not just a crypto company. You're the core infrastructure for the future of money. And all it takes is one light switch moment.
People ask me, what's the biggest surprise? Circle going public. I really thought that Bitcoin would serve the role that stablecoins are going to serve. I think because of that IPO, I don't know if it was the safety that, being backed 100% by treasury securities and AI and crypto together as we go towards agentic, also with DeFi threatening all of them as well. They better get with the program. So you're right, light switch. It's almost like a light switch. We think this could become one of the most important financial services institutions in the world.
Stablecoins are having their Chat GPT moment. You can feel it. Something fundamental has clicked. Just like Chat GPT made AI real and useful to the mainstream, stablecoins are making crypto real to financial institutions. They're simple, intuitive, instantly useful. No speculative chaos, no complex wallets, no apes or meme coins. Just dollars that move 24/7, globally, with finality. And the thing is, this didn't happen slowly. It happened like a light switch. Circle's moves in the past 12 months have changed everything. Their expansion into USDC as a service, their push into Asia, their looming IPO, their close work with regulators. This isn't just another crypto company. This is a fintech firm building at the protocol layer, the kind Wall Street has to take seriously. And guess what? Wall Street is finally listening. BlackRock's tokenized funds, Franklin Templeton's experiments on chain, PayPal launching PYUSD. They're not building on Bitcoin. They're building on Ethereum because it's where stablecoin rails already exist. Around 30% of Ethereum's network activity is driven by stablecoins. That's not just impressive, it's transformative. Forget NFTs, forget DeFi speculation. Stablecoins are actually being used, day in, day out, for payments, settlements, and liquidity movement across the world. Why? Because Ethereum is programmable, transparent, and battle-tested. It's becoming the financial internet, and stablecoins are the packets of value running through it. And unlike Bitcoin, Ethereum doesn't care what kind of money you use. It just wants to execute code, which means it's perfectly suited for tokenized fiat. Now, here's where it gets really interesting. Wall Street, long skeptical of crypto, isn't laughing anymore. They're building. Why? Because the model is suddenly obvious.
The stablecoin is the Chat GPT moment for crypto. Circle has blown the doors open. There's a lot of interest now on Wall Street getting involved with Ethereum and building stablecoins. That's 30% of Ethereum's network usage today.
Now here's where it gets really interesting. Wall Street, long skeptical of crypto, isn't laughing anymore. They're building. Why? Because the model is suddenly obvious. If you can move dollars globally, instantly, at near zero cost, and settle them on-chain, you've just leapfrogged SWIFT, ACH, and correspondent banking, and institutions are realizing that Ethereum plus stablecoins is the gateway to all of it. Treasury-backed, compliant, programmable money, that's the holy grail. It's not about replacing the dollar. It's about rebuilding it in real time. The biggest insight here? Stablecoins aren't just a crypto product, they're a platform shift. They're the connective tissue for payments, AI agents, tokenized assets, DeFi protocols, and even identity systems. A stablecoin is just a smart contract that holds dollars. But what it unlocks is everything else. On-chain payroll, tokenized treasuries, streaming payments, autonomous AI spending.